In this section, we're going to be looking at technical indicators. So technical indicators are the biggest part of technical analysis. And the definition for technical indicators, taken from Wikipedia here, is technical indicators are a fundamental part of technical analysis and are typically plotted as a chart pattern to try to predict the market trend. Indicators generally overlay on price charts, price chart data to indicate where the price is going or whether the price is in an overbought condition or an oversold condition. So what this means is, so if I pull up a chart here of, I'm looking at Euro USD. If I want to look at a technical indicator is going to be something that's going to be plotted, overlaid on this chart. And this technical indicator, which there's different indicators, the way it's computed is going to be based on the prices that you see here and or the volume. Nothing else. It doesn't take any news, anything else. The only thing it uses to compute itself is this chart that you see here in front of you. Okay? Now, different indicators are going to use different things to compute themselves and different ranges. So if I'm looking here at Euro USD, I can go on the top here and click on indicators. When I click on indicators, I'm going to see that there's all of these indicators that I can use. So there's average true range, there's oscillator, there's Bollinger Bands, there's RSI, there's moving average, there's VWAPs, there's all of these indicators, okay? And each of them is going to be computed in a different way, but all using the prices here and or the volume. So now we're going to look at different indicators. I'm going to look at the ones that I like the most for the Forex markets. Now, there's a lot of them. And it's not because there's a lot of them that you need to know all of them. A lot of them are useless and they're worthless, honestly. You can create your own indicator. A bunch of these indicators are just indicators that somebody just created, right? So you don't want to use too many of them, okay? And the one thing to remember is that all these indicators, they only serve to highlight something that's already visible. Since these indicators are calculated based on the prices, then you don't really need to put them on. You can just look at the prices and that would tell you what the indicator would tell you. The only reason why we actually use them is it makes it easier for us. It highlights this thing that we might be looking for that without having the indicator on and just looking at the chart, we might not see. So it just serves as a highlight. Now, you don't want to use too many indicators. You want to find a few that you like and that work well for your type of trading and use those. And the reason for that is when you use too many things, you lose predictive value. You know, if you do any type of mathematics, you know that when you have a formula and there's several unknowns, like let's say y equals ax plus bz plus whatever variables, right? And you have many unknowns. If you try to add too many unknowns, you're going to lose predictive value. And they found in mathematics that if you use over more variables, more than 5 variables, you start predicting less efficiently than if you had less variables. For example, if I'm telling you, how can you predict if it's raining outside based on, you know, what your girlfriend, boyfriend is wearing? Well, you can type kind of predict, right? Because if she's wearing something like a raincoat, then it's probably raining. If she's raining a skirt, then it's probably sunny. So, okay, that's good. Well, how could you predict the weather outside based on what she's eating? Well, I'm not too sure. How could you predict the weather outside based on her mood? Okay. How could you predict the weather outside based on the TV shows she's watching? How could you predict? If you start adding too many variables to try to predict this thing, you're not going to predict as well if you just took a few variables that have more value and just use these. And it's, I don't know if my example was good to get to what I want to say or the meaning, but a mistake that, you know, new traders do is they try to use as many indicators as possible. And I look at their chart and they have so many indicators. They're just going to go in and they're going to just add everything. They're going to add everything and they're going to look at everything. And they're going to be like, oh, well, this says this and this says this. If I have 20 indicators and 15 of my 20 indicators tell me that, then it should go up. Not necessarily. No, because some of them are going to be conflicting. You're not looking at the same thing. So it's a mistake that all new traders do. Okay. And I'm here to tell you, don't do that. Take a few indicators and we're going to look at a few and you're going to see me use them and stick with those and you're going to have way better results than just throwing all the indicators out there. So without any further ado, let's jump into the first indicator, and I'll see you guys in the next lecture. The first indicator we're going to look at is the simple moving average. What the simple moving average is an indicator which is basically just a line that we draw on top of the chart. And that line is basically computed using X amount of periods, averaged, and plotted on top of the chart. I'll show you exactly how it's done and what it's used for. So I'll grab an Excel sheet. Let's say we want to draw a 4-period moving average. A 4-period moving average. So basically we take 4 periods. Now it could be, by 4 periods, what I mean is candles. And when we talk about candles, we talk about the closing price of that candle. So if I'm taking, let's say, the last 4, if I'm looking at a daily chart, then I'm looking at the last 4 days. So I could have day 1 here, day 2, day 3, and day 4. Let's say on day 1, the closing price on that day was $10, right? The second day was 11. The third was, let's say, 12. And the fourth came back or continued going up to, let's say, 12 or 14. Okay, prices kept going up. Now, on the 5th day, what I'm going to do, this is the prices here. And I'll zoom in a bit here. You have the prices. Here I'm going to have the moving average. The simple moving average, and we'll call this 4 because it's 4 periods. So what I'm going to do here is I want to compute what is the average of these 4 previous days. Well, the average is going to be the first day plus the second day plus the third day plus the fourth day. This is the sum, so I have 47 divided by 4 because there's 4 of them. And this gives me the average of the last 4 days. And the average of the last 4 days is 11.75. Now, on the 5th day, maybe the price drops back to, I don't know, 9. Okay, price suddenly drops. Well, what is going to be the average on the 6th day of the last 4 days? Well, it's going to be this, right? It's going to be 11 plus 12 plus 14 plus 9. So we dropped the 10 because the 10th is 5 days before and I want to use the last 4 days, and I add the 9. So I do the average of those, and now the average is this. Now maybe the price stays at 9 the next day. Well, on the 7th day, what is going to be the average of the last 4 days? Well, it's going to be 11 because I'm using these 4 prices. So I dropped the 11, I added another 9. So it's dropping a bit. So what the simple moving average does is it takes prices and it does an average of the last X periods. And what that does is it removes the noise. So if something is really moving wildly, you don't want to see all this noise. You want to have an average of these days to have a better idea of what's going on, right? So in this case, I would see that, okay, prices are starting to drop, okay? And it's more fluid. And I'll show you on a real chart here in a second. But these moving averages, you can have a 10-day moving average or a 10 period or a 20 period or a 50 period. It's really up to you. So if I grab back my chart here, and let me just remove some of these indicators that I've added in the last lecture. If I look at this chart, I can go here and I can go on indicator, and you can look for it here. You can go to moving average, which is this one. There's a bunch of different averages, and there's exponential moving averages, which I'm not going to cover here because I've always just used simple moving averages. You can get the same thing from the simple one than the exponential one. So I don't really know a lot of people who use the exponential one. And the simple one just works pretty well. So you can Google the exponential one if you want, but for now, stick with the simple moving average. You can just write here MA for moving average, and you can find it. So all you have to do to add an indicator is just click on it. And here we go. We have this moving average now. You see, this line was not there before. And this line, I have a daily chart. The way it's calculated is basically like, let's say this point here, the way it was calculated is by using the last X periods to compute itself. Now, how many periods did they use? I can double click on it. They used the last 9 periods. So when you do a moving average indicator on TradingView, they default it to 9. So you can change it. Okay. So how many periods you want to use, I'll tell you in a second. But here, if let's say I put 4, then you would see that, let's say here, the way they drew this is by using the close of this one, 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 just sort of like we did. Now you'll see that if you have a very short period moving average, this line here is going to follow the prices very closely, right? If I have a longer period moving average, let's say 20, you're going to see that the line is going to lag a bit. The moving average isn't going to be as fast to catch on to the price. You see? Now it's more smooth. So if you want the smoother moving average, you put it longer term. It's going to be less impacted by the noise and by these candles. And it makes sense, right? If I'm using 4 periods and then the price jumps and I'm removing one candle and adding the new price of the other one new price entry over 4 has a lot of weight. So it impacts my moving average a lot. If I was using a 100 period moving average, I'm looking at the 100 periods. Well, if I'm dropping 1 day or 1 period and I'm adding a new one, even if this new one moved by a lot, it's only 1 out of 100 of data points. So it doesn't have a lot of impact on my moving average. So my moving average doesn't move as fast. It's very slow, right? So the longer term you're doing, the longer term moving average you want to look at, because you don't want to get caught up with all these small movements, right? Now, the moving averages that I recommend is the 20 period moving average and the 50 period moving average, and that's for Forex. Now, if you're doing stocks or something else, you want to look at the 200-day moving average, you want to look at other things, but for Forex, which is what this course is about, I really like the 20-day moving average and the 50-day moving average. So this here is the 20-day moving average, and you can see that it shows you something. Well, what does it show you? The moving average, what it shows you is the direction. So it's a trend. So instead of just looking at the prices and being like, okay, it's going down, or you can look at the moving average, and the moving average gives you the average of the last 20 periods, in this case, because it's 20 period moving average, and you can see that the direction is downward. So it's downward sloping. So it gives you an indication of the trend. Now, if you use longer period moving averages, it could also be used as support and resistance. In Forex, I don't use it as much for that. I use it in a different way, which I'll be showing you in another lecture. But you can be using the 50-day and the 20-day moving average, play around with it, and it'll give you an indication of the direction we're going. Now, you could use it as resistance points, support points. You would need to use longer period moving averages. But yeah, you can use the moving averages on either daily charts like this or any type of charts. You can use 1 hour charts. You can use, let's say if I'm going here, I can put 1 hour chart, or and you'll have the moving averages as well. You can do 15-minute charts. Whatever time frame you're looking at, it'll use the X amount of candles. So if I'm using a 1 hour chart and I'm using a 20 period moving average, I'll be looking at the last 20 times 1 hour, so last 20 hours to draw it, okay? So this is going to be the simple moving average. And what we'll do in the next lecture is actually add on top of the moving averages to see how we can use them to find entry and exit points. In this lecture, we're going to be looking at moving average crossovers. So moving average crossovers, what are they? The way it works is you draw 2 different moving averages on top of a chart. For example, let's say I look at this currency here. I'll go on, and it doesn't matter what time frame you're looking at. Again, the time frame depends on how long-term or short-term you want to be trading. If I'm looking at a 4-hour chart here of New Zealand dollar to US, and I add an indicator, moving average, I'll plot it here, and let's add a 20 period moving average. So I'll change this to 20. And you see, oops, yeah, 20. Okay. Then I'm going to add another one. I'm going to add another one, and I'm going to have the 20 period, which is the one I'm going to call my short-term moving average. And I'm going to add one that's longer term, okay? That's slower to react to recent price changes. Now, the second one here that I just added, I'm going to change it from 9 to 50. So I'll have a 20 period moving average and a 50 period moving average. And look at this. The 50 period moving average is slower to react than the 20-day moving average, right? Makes sense. 50-day more data points. Each data point has less value. So a new day, a new move impacts it less than the 20-day moving average. And what this tells me is that if I use moving average as an indicator of the direction we're going, as a trend, well, what if I have one that's shorter in term? So a 20-day one versus a 50-day one. The 20-day moving average is going to tell me about the direction in the short term versus the 50-day moving average, which is going to tell me the direction in a longer term. And what I can do is I can look at these two different moving averages and see if one changes versus the other. For example, if my 50-day moving average is going down and my 20-day moving average is going down faster, what that tells me is the last 20 days were worse than the last 50 days because the 20-day moving average is lower than the 50-day moving average, right? But then if at one point the 20-day moving average goes above the 50-day moving average, so it crosses over the 50-day moving average, well, what that tells me is in the last 20 days, prices were better than in the last 50 days. So we might be reverting. So we've been going in a direction, but recently we're starting to go in a different direction because the shorter term period moving average crossed the longer term moving average. We'll look at it here. So let's say here, for example, okay, we're starting off and we have the short-term moving average, the 20 period, crosses below the long-term moving average, which tells me in the last 20 days, and if I look at the last 20 days, this, the prices are lower than in the last 50 days, okay? And because the last 20 days has this really big, there's these few bad prices, and these few bad prices really impact the last 20 days more than they impact the last 50 days. So that would tell me that I need to short, okay? So at this point here, I need to short, which the prices, I'll be shorting at this price because here is what the price is. But this is the indicator. And since the shorter term moving average crossed below the longer term moving average, I want to short. I'll be shorting somewhere here, okay? Now, as long as the shorter term moving average is lower than the longer term moving average, I know that, you know, in the short term, prices are going in that direction compared to the long term. So I would stay in that position until we get to here. And I'll be closing my trade here. So I would have made some profit, okay? Now, at this point, we'll zoom in. The shorter term moving average goes above the longer term moving average, which tells me that now prices in the short term, in the last 20 days, are a bit higher than in the longer term, right? Because in this short term here, I have these days that have a bigger impact than on the last 50 days. So here I might have went long. I would have bought. This would have been a bad trade because I would have bought, but then right away, the 20-day moving average would have crossed below again because of this huge red candle, and I would have taken a loss. But that's okay. One good trade, one losing trade, which is smaller. Now, we crossed the shorter term moving average, crossed below the longer term moving average again. That would have been another sell indicator, another short. I would have shorted here. Then prices went down and again recrossed over here. So I would have closed my position at this point, another winning trade. And again here, there's a whipsaw. I would have went long. I would have lost on this trade, but barely. I would have bought here and sold here. Barely a loss. But here I would have shorted again because the shorter term moving average crossed below the longer term moving average. And I would have still had this trade open until today, which is pretty good because it's really deep in the money now, right? So this is how you would use it. It really tells you when there's a change in direction, okay? Because you have two different moving average, one short, one long, and the short really tells you what's going on more recently, the long, what's going on more not so recently. And when the recently moving average crosses below the not so recently moving average, it tells you that there's a shift or we might change. So you can use that to enter and exit positions. And that's where some of the indicators that you hear people talking about, like MACD, moving average convergence divergence, all of these other indicators, they're just based on that. So all you need to do is just use that because that's what they do. They take moving averages and they see how much they diverge or they reconverge and they try and do these things. Well, here you go. You can just look at it like this. And when there's the crossover, you know that there's a shift, right? And you can look at this in different places. Like let's say on this one, you can see that we crossed over. Well, we crossed over here. So you would have been in a long position and you would have stayed in this long. And you see the shorter term moving average. So the last 20 days here, right? Starting to slow down. Okay. And it's because these new days that are lower, the last 20 days are about to be less than the last 50 days. So we're about to cross below, and this would be a sell indicator. So we get out of it. We get out of our long position. So we take our profit on it and we even go short. And, you know, it's whenever you start trading and you learn about moving averages, it's the easiest way to get rolling, you know, and just practice. Obviously, when you're practicing, you practice with fake money. So it's not a bad idea to just play around with it because it's such a simple way to trade and to get experience in sending orders, seeing your positions, doing all of these things that you want to learn about. It's a nice way to learn about them because it's just a simple way of doing things. And you might like trading with moving averages, and this could be your way of trading, or you could trade with something else, but it's a good way to get practice. So, you know, add some moving averages to your charts. See if you can see, a crossover where you would want to enter a position or not. Anyways, we're going to be looking at entering positions and all that stuff at the end of the course. But start looking at your charts to see if you can see some crossovers. And that's really what crossovers are. You can play around with the time frames for your moving averages. You can try two shorter ones, two longer term ones. You can try different time frames on your charts. Play around with it. And yeah, that's it for moving average crossovers.